chapter 1. I am Florencia Roca. Hello. In this chapter, we will design an Excel spreadsheet to evaluate an investment project from the financial point of view. Then all the steps will be covered in the rest of the book. So here we will have a kind of plan for our work regarding the investment project. There are 3 steps that you can use to evaluate a project from the financial point of view. First, you need to forecast the financial statements, because here is where you can determine the returns, the cash flows, all the numbers of the project need to be forecasted. Then you can apply evaluation methodology. For example, the internal rate of return, the discounted cash flow, or the economic value added. That will provide with a first answer: is this a good project or is it not? According to our forecasts, is it going to be a project that will create value on capital or not, or it will destroy value? So we have a first conclusion here. And then we analyze it deeply using a lot of financial tools. For example, we start moving variables. What if we are wrong? What if our forecasts are not accurate? For example, here we calculate sensitivities, moving one number at a time. Then we calculate scenarios, moving many numbers, many variables at the same time. Or we can simulate the project the same way in aviation pilots work with a simulation cockpit. Well, here we can simulate the project and make decisions and see where it's going before we make mistakes in real life. We can simulate it here. And there are many break-even analyses. There are many studies that will complete the analysis of the project. So the first step, forecasting the financial statement. This is not accounting. This is not a formality. These are the numbers of the project. This will be the numbers of the project. So we need to forecast not only sales and costs and expenses, but also we need a good forecast of the balance sheet, because there are the investments. We will need to buy equipment, we will need inventory, different things, and that may change in time according to the growth of the project. So in chapter 4 you can see all the forecasts that you need, with special care of not including, for example, sunk costs, but including opportunity costs. There are some considerations that are important in terms of making a decision. This is not an accounting forecast, it's a forecast to make a decision about a project. So it needs to be in touch with reality, it needs to be completely honest, and it could be part of a business plan. And then in chapter 6 you can forecast all the assets that the company or the project will need, and this is the balance sheet, and then of course how it will be financed. Remember that this will be difficult because we are not trying to assess the weather for the next 2 or 3 days. We are talking about the social science. Peter Boettke says on his book Living Economics, he says that the facts of the social sciences are those things people believe and think. So when we try to forecast sales, when we try to forecast expenses, because we're talking about people, this is social science, it's going to be very difficult, we're going to make mistakes, and there that's where the importance of having a good plan and analyzing it, moving variables, doing all what we call the what-if analysis. It's very important because of this. forecasting in social science is very different from natural sciences. Here, the same input will not produce the same output. So take this into account with the forecast. We're going to make mistakes. The future is uncertain, but it does not mean that then we can work without any plan. On the contrary. This could be a great tool in order to anticipate the needs, for example, the financial needs of the project. In chapter 5, you will see the cash flow, the forecasted cash flow, which of course can be deducted from the financial statements that we forecasted before. And this will be a very important input for valuation. Okay, there are two important numbers. Make sure that in your Excel spreadsheet you put special attention to these numbers. One is the NOPAT, net operating profit after tax. This is the profit of the business. It will be forecasted. It will be calculated in the or as part of the income statement, or after you have a forecast of the income statement. It's a profit, of course. It's going to be in the income statement, and it's the profit that this business will produce. And the second input, which is important, is the capital, the amount of invested capital, which will be the most important number that we're going to deduct from the balance sheet. In other words, we need to know about the calendar of investments. A very common mistake for entrepreneurs is to only forecast sales and costs and think that, well, the project will finance itself. Once we start, then we'll make all the investments with the money that the project will produce. That's a huge mistake. That's how most projects end up running out of cash. Sometimes the profits that the project generates will not be enough to cover all the investments. Sometimes there are jumps in the investments. For example, we need to build a plant in the future. So if we have a good forecast, then we can estimate capital, and included in capital are all the investments. As a result, we can estimate the free cash flow. You can see this model in Excel. You can download many examples from the book, and here we have some suggestions. For example, it's very important to separate the assumptions. We're talking here about the future. Sometimes we have some history, so it's very important to separate what is a fact and is not subject to discussion or conflict, and what is an assumption, because assumptions may change. So we suggest to separate all the assumptions and also classify them. For example, assumptions we have control over, income statement assumptions, for example, how much we're planning to produce or sell, and others that are, for example, macroeconomic assumptions, the interest rate, and we don't have much control over them. So it's important to separate them in a spreadsheet, or at least to classify them. And if we do this correctly when we start building the financial model for the project, then it will be easier to perform all the tests, the sensitivity, simulation, etc. We also suggest to include an executive summary, which should be automatic. It should change as the Excel changes. But this is not only important for presentations. For example, if we are negotiating capital for the project, or we are negotiating with investors, this is not only important for that, but it's important to have a big picture, to not to be lost in all the numbers of the Excel. So here we can see automatically in the Excel spreadsheet what's going on with the project in general. So how do we evaluate a project? Let's go to the second step. There are many methodologies in finance that you can apply. The most common and also accepted are those based on cash flows, which is a simple idea. A project needs to generate cash. If it's an investment, it should not destroy the wealth of the entrepreneurs or of the investors. It should create wealth for them, make them richer, not poorer. So this is a very simple idea, is accepted, the discounted cash flow methodology. If you also like to estimate the return rate, the internal rate of return, you can do that as well. And finally, we suggest to add a methodology called EVA, the economic value added, which is consistent with the other two, but it will explain clearly what's going on with the project, whether it's going well or not, where changes are going to be needed, in which areas or lines of the project we are better than in others. So in this part, in this second step, as we mentioned before, we obtain a first answer about the project, which is good or bad, should be carried out or not, as simple as that. We do it with different formulas, as I mentioned before, and we have a first conclusion. This can be found in chapters 2 and 3, where you will calculate free cash flows, and then in chapter 7 you can see the weighted average cost of capital in detail, and in chapter 6, of course, the economic value added step by step to evaluate the project. So as you read the book and you download these spreadsheets, you can take your project and go through all the steps in order to end up with a finance evaluation of the business. Finally, third step. Now we have a conclusion. This project is good or bad. Now we need to know why. Where is value coming from? Or if the results are not very good and we would like to, we don't want to abandon the project, we want to fix what is wrong, we want to think again about the project, then we need to detect the areas where we're strong and the areas where we are weak. So here we have we start iterating moving variables and analyzing deeply about the financing of the project, about the returns, about the margin turnover, the break-even point, etc. So this is the third part that you can find in the last part of the book. For example, we calculate all the ratios using the DuPont formula, we link them to the returns, and we build like a value tree or a return tree. And then we analyze cost, expenses, all this in chapter 6. Then, because it's linked to EVA, that's why it's in chapter 6. Then we may perform a sensitivity or a scenario analysis. There are many tools in Excel that will allow you to do this quickly and easily. So in the sensitivity part, we use the table function of Excel, and then the scenario tool with Jorge. You will study the project more deeply and make use of these fantastic tools that you can find in this spreadsheet, or of course you can use any other, not only Excel, but there are many spreadsheets that you can build with the same methodology. So in chapter 10 you can see all the sensitivity and scenario analysis, and then the simulation. There's also a chapter 12 with options, 12 and 13, with real options that can be added to the project. That's a further analysis. There are also the adjusted present value, the analysis of the financing. There are many studies that will allow us to go deeply in the project. And finally, chapter 15, 16 are new. This was a book in Spanish, and we are in the second edition, so those are new, and those are all examples and templates. So you can see all this theory in action applied to concrete investment projects. You will find many examples in the last chapters, employing different tools for different sectors or projects, and you can download, of course, the Excel spreadsheet. In conclusion, we need a financial model in Excel or any other spreadsheet, separating different parts. First, make sure you have the assumptions classified and in one spreadsheet. Then all the forecasts, the financial statements, the cash flow forecast, the return forecast, the calendar of investments that needs to be separated. And it could be a source of conflict if we present the project to investors, for example. Assumptions and facts should be clearly separated. And then forecast, of course, will depend on assumptions. So if we move the assumptions, the forecast should change as well. Then the valuation. Valuation should be also clearly separated, because it means to apply a methodology on the numbers that we already forecasted. So there's no much conflict about this. It's a very common, the tools we are using are accepted in the finance academy and also practitioners today. Then all the tests that will allow us to go deeply in the study of the project, for example, the simulation analysis or real options, etc., and a summary. And an executive summary, the big picture of the investment project. This is the way we're going to work. I hope you like it. All the theory will be covered in the book, and at the same time, we will work on Excel spreadsheets step by step. You can see the videos and you can download the spreadsheet. Thank you very much. I'll see you soon.